Good morning, everyone. My name is Sakim Ryan, the resident crude oil trader here at JNF Capital. Today is Monday, 16th February 2015. I will be giving you an insight into my positioning here on the crude oil market. Before I get started, please note, investing in the financial markets is not for everyone, as losses can exceed deposits. As you're aware, as I've mentioned previously, the market is made up of both buyers and sellers, bulls and bears. What I do as a trader is simply identify who is in control and align my clients' funds in the same direction as the controlling entity. So let's have a look at what's happening in the markets. So let's try and find out which entity is in control. Is it the bulls or the bears? Fundamentally, we are still majorly oversupplied. Okay, so it's still fundamentally we feel that it's a bearish picture, and I'll give my explanation for that. I mean, last week, Wednesday, 3:30, we had the inventories out again, as we always do. We were expecting a build of 3.8 million barrels. However, we got a build of 4.7 million barrels. Now, if you've been keeping track, that is the 6th straight week of builds that we've had. And as I have previously already mentioned, crude oil inventories in storage are at the highest level since 1980. So of course, from as far as storage and supply is concerned, that's a pretty bearish picture. Now let's have a look at the rig counts. So last week, again, according to data collected by Baker Hughes, we saw a decline in rig count. To about 90, we had a sort of decline of about 98 rigs that came offline last week. I mean, that's previously, the week before that, we had a decline of about 83 rigs. Okay, now I'm sure you must be thinking a decline in oil rigs generally should be bullish for the market, right? However, we had an interesting report that I read from the EIA. Basically, according to their research, in the Balkan region, oil has actually, the amount of oil pumped out per rig has actually increased by 8.9%. Now, that is expected to reach a record of about 1.32 million barrels by March. So, despite the fact that we are having drops in rig counts, the amount of production coming out of the existing rigs, or the leftover rigs, is actually climbing. So this kind of, not only does it offset what is happening with the rig count, but it starts to paint a little bit of a bearish picture for you. Okay. Aside from that, you already know from last week's video, things have not changed. There has been a massive increase in global production from the OPEC and the non-OPEC members. Chinese trade data, economic data is still very weak. So generally, the picture is very bleak for crude oil as far as demand is concerned. And also, of course, we've just got a massive oversupply as well. That is where we're at as far as the bears are concerned. Let's try and have a look and see what the bulls are doing. Okay, so moving on to what the bulls are doing, right? For the last 6 months, I've struggled to find a decent argument for having a position as a bull in the market. However, now we are starting to find reasonable arguments for the bulls. Okay, let's talk about a couple of them. Starting with the most recent news piece of data that we've got in. Now, next month in March, Nigeria, Africa's largest oil producer, is going to be holding elections. This is a significant event for us because the last time Nigeria had elections, they cut production in the region of about 850,000 barrels. That is a very large cut in production, especially since they're currently producing in the region of about 2 million barrels a day. Okay. Moving forward, let's have a look at the OPEC supply and demand dynamic. Okay. Now, OPEC has estimated that the demand for their own product will be in the region of will grow in the region of about 120,000 barrels a day this year. This is a major turnaround because according to the last report, they were estimating demand for their own product to drop by 300,000 barrels per day. So as you can see, that's like a 420,000 barrel turnaround in their estimates. Okay, now you take that and then you have a look at what they're estimating. What they have currently, they're estimating global demand to average somewhere in the region of about 93.2 million barrels a day this year. That's year-on-year growth for about 1.7 million barrels. Now, if you have a look at what they're estimating as far as supply is concerned, according to OPEC, non-OPEC supply is going to drop from supply growth is going to drop from 1.27 million barrels to somewhere in the region of about 860,000 barrels. So you can see basically what they're saying is, in a nutshell, our crude oil demand for our crude oil is going to grow, and demand for supply growth as far as non-OPEC is concerned is going to drop. Okay. Now, last piece of information that we have as far as bulls are concerned, we had research out of Black Diamond Research. Now, Black Diamond have found an interesting correlation between the bottom in oil prices and the average decline in rig count. Now, basically what they found is that we have, on average, basically, when rig counts drop to the region of about 25%, WTI prices start to carve out a bottom. And this is supported historically as well. From their research, I was able to deduce that in 1999, during the Asian crisis, rig counts dropped to as far as 33% before WTI prices started to carve a bottom. In 2002, during the tech crisis, crude oil, their rig count dropped to about 22% before WTI carved out a bottom. And in 2009, the most recent oil crash, which is the Lehman Brothers fall, we had a drop in rig counts in the region of about 20% before WTI carved out a bottom. Now, where are we as far as our current rig count is concerned? Well, as things are stated right now, we've already seen a rig count drop of about 29%. So this is a pretty compelling argument to support the fact that bulls might be taking control over from the bears right now. So what are my trading levels this week? Now, for those of you who watched my video last week, you would know that I mentioned 49.90, 49.90 is a very big level. I actually mentioned that on my Twitter as well. Every time the market comes to 49.90, we see surges in volume, okay? And you can really see the battle taking place between the bulls and the bears. Now, what I've said is clearly that above 49.90, I am bullish, okay? Market is currently trading somewhere in the region of 52.71 again. The week before that, we had the market drop down 49.90, come back above it, and it's done the exact same thing again. So to protect some profits, what I've done is we got in at 49.90, brought our protective stops up above 49.90 to conserve that. So it's a risk-free trade now. Okay, I do have levels where I will be adding to this position to the long side. In the event the market reverses, I do have a level where I will be looking to go short. Like I said, I don't inflict my opinion on the market. I'm simply looking to see what the price is telling me, what the volume is saying, and just to make sure that I'm on the right side of the market, whether it's going up or it's going down. Now, if you would like access to my exact trading levels for this week, please use my contact details on the following screen. Get in touch. A member of my team will help you gain access to my crude oil report. Also, you can follow me on Twitter. My Twitter handle is @OrionOil. You will see that on the following screen as well. Well, that's it for me this week. I look forward to seeing you next week.